Bloomberg Audio Studios.
Podcasts, radio, news.
Good morning, everybody, and we'd like to thank John Williams for joining us on Bloomberg Radio and Television Worldwide. John, numbers just came out. Pretty amazing. Are you continually surprised by the American consumer?
Well, first of all, welcome to the New York Fed. We're celebrating the 100th anniversary of this building here on Liberty Street. The consumer spending has been strong. I think it is driven by strong fundamentals. Job growth has been solid. We've seen real wage gains. We're in a pretty strong economy with good growth. So yes, it's part of that story. But I think what we're realizing is we're getting a nice tailwind from the supply side of the economy. Good labor force growth, strong productivity, good real wage gains. So with that, I think consumers are spending.
What's the thinking in your office and among your colleagues about, does this last, or is this a surprise that you think could go away at any minute?
Well, one thing that makes it really hard to forecast is we're still feeling the effects of the after effects of the pandemic and Russia's war in Ukraine and all the things that have happened in between. So we're definitely still seeing an adjustment process by the consumer, in the economy overall. But overall, I think that the economy will continue to grow at a solid rate this year, probably not as high as the 3.1% we saw last year, but something like 2% or around that. So I feel like we're still in a good place, probably not as rapid a growth as we saw last year.
Speaking of international events, I have to ask you, the Middle East going on right now, how do you think about the economic and policy implications of these events?
Right. So obviously we're watching this very carefully. I think the primary way you see it through is, first of all, through commodity prices, but second is, what we think of as a flight to safety, where investors, when they see risks in the global economy, they tend to bring money to the U.S. dollar, and that tends to push yields down somewhat. Right now, I think, markets are pretty stable. We're not seeing big movements in that way, but generally that's the way what I would expect to see when you see heightened geopolitical tensions.
When you think about what the markets are reacting to and what could come out of this, is this more of an inflation worry or a growth concern?
Well, it's really hard to say. It really depends on how the situation evolves. Right now, I don't think of this as maybe in the near term. It could be effect of financial conditions and commodity prices, as I mentioned. I don't see this as a major driver of the overall forecast or outlook for economic growth or for inflation.
Speaking of inflation, CPI came in much hotter than expected and sort of freaked everybody out on Wall Street. And markets sort of took that as a turning point in Fed policy. Do you see it that way?
I don't see it as a turning point. I think that, we saw inflation come down maybe quicker than we expected last year. We definitely saw really lower readings in inflation in the final 6 months. That I never thought that was going to stay that low. That was kind of unusually low. We're now seeing some a little bit unusually high readings. Overall, I think the picture is one of the economy is getting in better balance. We still have a strong labor market, and we're seeing inflation gradually come down. Now, I do think that for me, what do I see in the data? Well, the economy, and you pointed out the retail sales today, but more broadly, the economy continues to be strong. Again, I think we're being helped by strong demand and supply, and those are helping growth. And we're seeing inflation come down a little bit slower than expected. And so I think markets are taking all of that information into account and how they expect policy to be. For me, I'm data dependent as always. Really take the totality of the data and think about what it means for achieving our maximum employment and price stability goals. So I don't see this as a game changer or anything. I do think it's important information that will clearly, affect my thinking and my forecasts.
Even those who've thought about what PCE might be after the PPI and CPI say inflation isn't coming down rapidly anymore. But you do have the strong growth. You have very low unemployment. Why cut rates if the economy is doing fine at this level?
Well, first of all, I think monetary policy is working at the rates that we have now. So I think monetary policy is in a good place. Over the past 12 to 18 months, we've seen pretty much all the measures of imbalances in the labor market and our economy recede, many of them back to levels we saw in 2018 or 2019. So we're seeing restoring balance in the economy. We are seeing a slow decline in and inflation. So I do think monetary policy right now is in a good place. I'm not fixated on where do rates need to go, over the next year. What I'm focused on is how do we best achieve our maximum employment and price stability goals. The data we're seeing show that the economy is strong, and that's really good news, and labor market is strong. At the same time, we are getting better balance, and we're seeing some decline overall in inflation. So for me, it's really about getting that right, and then whatever we need to do to adjust monetary policy, we can do to best continue the progress towards our goals. So that's how I'm thinking about it, and we'll just have to keep watching the data and make the decisions based on those goals.
Well, is your base case that you will cut rates this year?
My own view is I think that with inflation continuing to gradually come down, and I guess I would say gradually is the operative word here, and with the economy remaining strong, I do think that given where the level of rates are, real interest rates now are considerably higher than they were before because inflation has come down quite a bit. So we will need to start a process at some point to bring interest rates back to more normal levels. And my own view is that that process will likely start this year. But again, it's going to be driven by the data and achieving our goals.
So it's possible you don't do anything this year?
Well, again, you're asking me to speculate on what will happen over the next 8 months.
Of course.
And right now, I think monetary policy is in a good place. We're seeing the progress. We're seeing progress. It's a bumpy road on the inflation front, and we'll just have to figure out how to best adjust policy as needed to achieve our goals.
Well, you mentioned the real rate. Is policy tight now?
I do think we have restrictive monetary policy. I do think policy is tight. So what do I look for? Because the economy is growing. It grew over 3%. We're adding about 275,000 jobs over the first 3 months. So that seems like an economy that's really strong and not being held back by monetary policy. But if you take a step back, all these measures of imbalances in the labor market, whether job openings or wage rates or quits rates or all the other indicators we look at, all of them are moving from being very tight to less tight, and most of them back to more strong labor market or getting closer there. I mean, job openings are still high, wage growth is still a bit high, but these are all moving in the right direction. So I think the stance of monetary policy has really been an important driver of restoring balance to the economy and helping bring inflation to 2%. Towards 2%.
What's left with inflation? Is it something that you can affect, or are these non-interest rate responsive sectors?
Monetary policy can affect inflation and the economy. It works through multiple channels. So there are some sectors that maybe are not as interest sensitive, but the economy is interest rate sensitive. We've seen that over the past couple of years as we've moved from a accommodative policy to a restrictive policy. So monetary policy is working. I expect it to continue to work to bring inflation down. You're going to see it show up in different parts of the inflation rates, goods versus services and things. But over the past year and a half, we have seen a broad-based decline in inflation in all of these categories. It's just that we haven't gotten all the way to 2%, and we just need to keep policy in the right place to achieve that 2% goal.
Question I always ask is, what are CEOs, companies telling you these days about their hiring plans, about what they're having to pay, and about inflation, whether they're raising prices or having to pay higher prices?
Well, clearly, if you asked me this question a year or two ago, that's all they would be talking about. Price increases, compensation increases, the challenges of hiring employees. Today, I think those comments are still out there a little bit, but far less than before. We're hearing from our contacts, that it's easier to fill positions than it used to be. Wage compensation pressures are less, and price pressures are less. I think that's consistent with what we're seeing overall in the data.
You're the potential growth guy. Has potential growth moved up?
I am getting more optimistic about potential growth in the economy, I think, for a couple of reasons. One is, through the pandemic and everything that happened after that, I, like most people, had concerns that the supply side of the economy had suffered, damage, the labor force in terms of labor force and participation. And as we've watched the data over the past 2 years, we've seen a increase in labor force participation, increase in labor force growth, and we've seen a rebound in productivity. Now, I'm not saying that we're in some, new high growth kind of world, but I do think potential growth is probably closer to 2% or a little higher, which is well above a lot of estimates of the past few years. And that's a very positive sign for U.S. real incomes and for the economy, and honestly, for helping get inflation down.
A question for all of our friends around us on trading desks. You had a briefing on QT at the last meeting from the Fed staff, and members, according to the minutes, generally agreed that it should start soon. Does that mean May, or does that mean June?
Well, I think we said fairly soon, and I think that the reasoning for slowing the pace of reduction of our balance sheet makes a lot of sense. It's a prudent course of action. We are decreasing the balance sheet quite rapidly, and by slowing that, we'll have more ability to monitor, assess, and analyze as we get eventually to an ample reserves kind of world that we're aiming for. Everything is going with the balance sheet. Everything is going exactly as planned. Things are going well. When we decide to, slow the pace of the balance sheet, that's a decision for the committee. No decision was made at the last meeting, but obviously we'll get together relatively soon and discuss this further. But to me, this is a sign of success of the plans we laid out almost 2 years ago to reduce the balance sheet. We've had very little disruption in markets. It's worked exactly as planned, and we're just executing on that plan, and that's going very smoothly.
So QT could come before rate moves.
Yeah, these are really separate issues. I mean, on our shrinking the balance sheet, we're focused on getting to ample reserves. On monetary policy, we're very focused on achieving our maximum employment and price stability goals. Those are different objectives. Those instruments can obviously move at different times in different ways.
John Williams, thank you very much, President of the New York Federal Reserve.